And we are now recording this session from Talking Hedge Events, and I would like to turn things over to Meg Bodie, the president and founder of Talking Hedge Events. Meg, take it away.
Terrific. Thank you again, Ken. Welcome back, everybody, to our Friday series. This is now the 5th in our series of 8 webinars replacing our Austin conference. I hope everybody is healthy, getting their jab, and getting ready to turn the corner on the pandemic. That would be terrific. We are hoping to get to Austin next spring, and at some point, I think we'll make that part of the poll, whether or not those of you out there would like to take that trip with us, maybe next March. That would be exciting. Anyway, I want to jump right into this. We have a terrific conversation for you today. Once again, really taking a different look at this low interest rate environment, but this has been a main topic for this series. Certainly, it's been a conundrum for many investors out there. So very interesting perspectives today, including solutions. This is a very forthcoming group that's going to talk about what they're actually doing with their portfolios. So that's really good stuff. Again, just to repeat, the views and opinions shared with you today are those of the participants, not necessarily the companies for which they work. I want to thank our industry sponsors for supporting what we're doing here at Talking Hedge. And those include Efficient Capital and SLC Management and InnoCap and Lixor and InfraHedge, which is a division of State Street, and Crable and Graham and Rowe and Teza and O'Brien Investment Group. And I think I got everybody. I did. So now, without any further ado, we hope you enjoy today's session. Marat, would you like to jump on? Suzanne, Paul, and John, please turn on your cameras and your microphones. And I'm very delighted to introduce the master moderator, Marat Maliboga from Efficient Capital. Please take it away.
Thank you so much, Meg. Thanks, Ken, as well. Hello and welcome everybody. My name is Marat Maliboga. I'm the Chief Risk Officer and Director of Research at Efficient Capital Management. For over 20 years, we have been specializing in building customized multi-manager solutions for institutional investors. And we allocate about $2.5 billion to trend followers, global macro, and unique diversifying CTA strategies. I'm very excited about today's panel because the topic of investing in a low yield environment is very challenging, but also it's relevant to all of us. As you know, the new risk-free asset S&P 500 is at all-time highs. The government yields are extremely low. The 10-year note yields only about 1.5%. As you also know, the Fed is expected to keep short-term rates close to zero for the foreseeable future, and more institutional investors are concerned about inflation coming down the road. And just a couple of days ago, I was looking at the most recent GMO forecast, and it shows that the expectations for international and domestic stocks and bonds is negative in real terms for the next 7 years. So this is a very, very challenging investment environment. I'd like to point out that this topic can also be quite controversial, and the decision I make in my portfolios can be different from the decision you should be making for your portfolios, because we have different investment objectives and constraints. So if our panelists disagree with each other, it's a good thing because they have different portfolios. Also, I'd like to point out that our panelists are a great fit for the topic because they represent 3 very successful firms from very different segments of the investment universe. We have Suzanne, who represents an asset owner. She manages retirement, endowment, and insurance portfolios. Then we have Paul, who is from a quickly growing consulting firm, and he thinks a lot about positioning hedge fund portfolios for his clients. And then we have John from a very successful asset management firm who works with a very broad range of institutional investors. So we're going to have a perspective of an asset owner, a consultant, and an asset manager to help you guys position your portfolios better. So at this point, let's take a few minutes to get to know our panelists better. I'm going to start with Suzanne. Could you please talk about yourself, your firm, and your role at your organization.
Thank you, Murat. So I'm Suzanne Galey. I am with Common Spirit Health, which was formed through the merger of two very large healthcare systems. Today, Common Spirit Health is the largest not-for-profit hospital system in the United States, in about 20 states. And the mission is to offer high-quality healthcare to the underserved. And I lead their equities and directional hedge funds, and joined 3 years ago from Texas Teachers, where I was a part of the public market strategies team. We are a $23 billion organization led by our Chief Investment Officer, Alyssa Reeder.
Thank you, Suzanne. Paul, could you please introduce yourself as well?
Sure, thank you. So I'm Paul Krasimer, and I work at Veris Investments. And we are, as Murat said, we are a consultant, and we advise on over $400 billion in assets. And then we also manage their outsourced CIO portfolios, a little over $3 billion. I'm responsible for the hedge fund effort. And in practice, that means I do research on individual hedge funds and then spend a lot of time talking about how to build custom portfolios for clients.
Thank you, Paul. John, could you please go ahead?
Thank you, Murat. My name is John Linder. I am a managing director in business development and client strategy with SLC Management. SLC Management is the institutional asset management subsidiary of Sun Life Financial, the global insurer based in Toronto. SLC Management has approximately $240 billion in assets under management in the areas of public and private fixed income, investment grade and below investment grade, real estate, including core and value added and opportunistic, and renewable infrastructure. So all income generating strategies for institutions. My background is in consulting and included the creation and promotion of a crisis offset or risk offset strategic class. And I currently work with clients to propose solutions for their fixed income needs and risk management needs.
Thank you, John. We're actually going to talk about the crisis risk offset later today, so I'm very excited about that part of the conversation. We're going to cover a lot today. We've decided to break this conversation into three parts. The first part is really going to be about answering the why question. Why should we waste our Friday morning listening to this panel? Are institutional investors really concerned about the market environment, or maybe the trends we've seen over the last 10 years are going to persist? Or maybe we are at an inflection point and we need to reposition our portfolio. So the second part of the conversation is going to be dedicated to answering the how question. And we're very fortunate to have Suzanne, Paul, and John sharing some of the changes they're currently making to their portfolios to prepare for this difficult environment. And finally, the last portion is going to be very interactive. We would love to hear questions from the audience. Please submit your questions through the Q&A feature. And also, please respond to the poll questions because we'd like to tailor our panel discussion to help you make decisions about how you can improve your own portfolios. So again, if you could please post the poll questions, we'd love for people to start answering those. Okay, so let's jump into the discussion. We're going to start with Paul. Paul, I think you have a very exciting but also difficult job. You work with a very broad range of institutional investors who have very different objectives and constraints. So just give us some intel about what you're hearing from. What are your clients concerned about? Are they worried about this environment? Are they asking you questions about how you think we should reposition portfolios? What are you hearing from them?
Yeah, well, thank you, Murat. And the short answer to your question is absolutely yes. And we start, as a firm, we really start with strategic asset allocation. And so the issues to point out that jump off the page really are what about low interest rates? And what does that mean as you build a portfolio, as you're trying to achieve your return objectives? I think another issue that's a bit more subtle is if you look up, but it goes to your changing environment question, is if you look over the last probably 20, 25, 30 years, stocks and bonds have had a negative correlation with each other. I think clients are also starting to think about what happens if that correlation changes and what does that mean? And very simplistically, when stocks and bonds are negatively correlated, you can think of them as hedges. If they're positively correlated, they become two different exposures, and the risks generally accelerate upward, which means clients need to go out and find new hedges or they have to adjust. But we're definitely seeing clients, I think in 2021, as clients are running through asset liability studies, the low interest rate environment is the question that's really front and center.
Thank you. Actually, I know that, John, you are an expert in fixed income. You looked at relationships of stocks and bonds. Like, what are your thoughts about the breakdown and correlations between stocks and bonds?
Well, I like to think about, that question. Of course, that is the $1 trillion question, right? So if effectively we have a breakdown in correlation between stocks and bonds, it's going to be because they're correlated to a third factor, and that third factor is inflation. And the issue is going to be, if we do get inflation, that correlation to inflation is going to be a negative correlation, and both stocks and bonds are going to fall. And so I am not a huge believer that we're going to get runaway inflation, just because it's in nobody's interest, particularly the Fed, to allow that to occur. But I do believe that we're likely to see a significant, not significant, we're likely to see higher rates, 5 years from now. And that's a good thing, right? Because everything has gone reasonably well, and the economy is doing really well, and so effectively we need to deal with that, what we're hoping is going to happen, while still protecting the portfolio from what we know can happen and likely will happen. We just don't know when, which is the next economic drawdown.
Yeah, I think what makes this topic is so controversial is that it's really hard to get, for us to get a consensus of even inflation. Like, do they expect to see inflation or deflation going forward? So actually, I cannot wait to look at the results of our poll later in the discussion, because I think there are lots of unknowns in the future. That's why it's important to hear different perspectives and learn from other people. So Suzanne, I know that you've done a pretty significant change to your strategic asset allocation. It was a pretty significant effort at your organization. Could you please tell us a little bit more about what you've done, and what type of analysis you've done, and what your conclusions are?
Yes, I want to jump into that, but I want to add one comment to what John was talking about, and maybe runaway inflation, or things like what you might have seen in Brazil, or the things that our parents saw in the 70s, is something that we just don't even understand how to both live in or invest in, right? Those people are not around on our desks. But there is an interesting situation that we might be facing with respect to tolerance for inflation, and that is if the Biden packages of some of these things, the spending gets to where it is, as Ray Dalio says, inflation will dig you out of your hole of your debt liabilities, because you can outgrow your liabilities. And so that maybe is one of the things that might be shifting the point of view of sort of where inflation goes. And therefore, what do we do with our fixed income allocations? What do we think about our deflationary or shock exposures, which I still think we're going to be exposed to? But to your specific questions, and as an asset owner, so I'm 3 years into my relationship in employment at Common Spirit Health. We're an asset owner, right? We're an operating business that has cash flows. And of course, the healthcare systems were challenged during COVID. And so we get to see bullish environments as well as straining environments. But what have we've done? For those of you who don't know, healthcare organizations are complex. We have balance sheet capital for our future growth of our businesses. We also have an open pension plan. So it's not an ERISA plan, but it still has similar risks and asset allocations to a pension. And then we also have insurance pools. Each of those pools has a different investment horizon. And so we think about our asset allocation specifically back to some of the things that Paul was talking about, which are so important, which is what is the strategic asset allocation that serves your risk as well as your return needs. We have made some significant changes. I'll flash a few of them. One of them is, unlike Texas teachers, we think about fixed income using the Bloomberg Barclays Ag. And so that does include treasuries, but we can be significantly underweight treasuries, in other words, active there. And so it'll be interesting to see how John brings the role of treasuries and even the risks of in various duration points of view to that conversation. I'm an equities person, so I'm definitely going to be relying on John for that. But in our operating pool of capital, we have moved more than 4 points away from our strategic asset allocation to fixed income, which is significant. And we've also trimmed our non-ag exposures, the high yield and emerging market debt, just a tad. It's a small allocation. And what might surprise some folks is that we're putting it in private equity, we're putting it in hedge funds, which our book is mostly absolute return hedge funds, and even some to real estate, where we have a larger allocation to core income generation pools of capital. So I'll leave it there. I can provide some other information, but it is interesting to see where we have moved and we've actually moved, as opposed to sometimes just talking about it, but not doing it.
Yeah, thank you. What's really interesting is that, I talked to a lot of investors, and a lot of them just say, hey, we don't need to make significant changes. It's business as usual. And they make a comment about, hey, inflation is unlikely. But what the interesting point I think you're making is that it's not just about inflation itself, but how sensitive we are to inflation if it happens. How vulnerable are we to that event? Even if inflation goes up a little bit, because if the sensitivity is high, it can actually be very, very dangerous for the portfolios. I think
it's also kind of just about, and this is where I'm curious where Paul's thinking about, because I'm one organization, and that is, at the end of the day, we're total return seeking, right? But we're total return seeking in inflationary environments, deflationary environments, shock environments, and normal growth environments. Anyways, I didn't want to take the mic from you, Murat, but the bottom line is total return.
You're right. And it's not a problem. You can take my mic away. We're having a conversation and we're trying to learn from each other. So yeah, well, let's go to Paul, but then I'd like to go to the CRO a little bit later. So what's interesting is that you talked about, increasing your hedge fund exposure. And I think we're fortunate to have a hedge fund expert here, Paul. And I'm just curious, so Paul, when you look at, at a high level, when you look at hedge funds, how do you categorize them? Do you look at them as risk mitigation strategy and alpha managers? Do you look at, discretionarily systematic? Just how do you describe the hedge fund landscape? And would you consider the hedge funds are an asset class? So basically, please help us understand the hedge fund universe and how somebody like Suzanne can actually benefit from tapping into the hedge fund universe.
Yeah, so I'll start at a very high level, and I'll try to go back to some of the things Suzanne also said to you with time permitting. But the first thing I would say is that both I myself and Veris would absolutely live and die on the hill that hedge funds are absolutely not an asset class. Hedge funds are, I think, best thought of as a group of managers that are using very sophisticated strategies in specific vehicles to make returns. And I think when you start then slicing and dicing and decomposing that, which is needed because it's such a heterogeneous pool, broadly speaking, we think of hedge funds as either return seeking, and at a high level, that's going to be the other thing. Well, we consider what they're trying to do in the portfolios and the degree to which they're return seeking and how that corresponds to risk in correlation to broad asset class groups. So for example, Suzanne talked about heading up directional hedge funds in equities. We would say that if we had our preference, we would tell a client that an activist manager, to use maybe an example that would resonate with her, an activist that's maybe 80 to 90% net over time should probably best fit within an equity portfolio. You could
Absolutely.
probably drill into whether they're US or global or non-US. There's a lot of granularity you can go from there. The same thing on the fixed income side. A manager with probably a high net exposure to credit and probably high yield would fit a fixed income bucket. The other hedge funds we would throw into more of a diversifying or risk mitigating strategy. And that's where you get trying to tie all of this together. That's where I think you see even more granularity. And I think it may be helpful to go back, jump to a high level and think about why did people hold bonds in the first place? Try not to tread on John's toes, but when treasuries were like a 10-year with a 5% yield, you got a good coupon. And then you also got downside protection, especially in the last 20, 25, 30 years when the Fed would step in when the economy was having issues. And so you had negative correlation or zero correlation, low correlation to equities when they were selling off. That was really the best, in hindsight, that was the best of all worlds. With bonds at 1.5, then investors are looking elsewhere. And I think to some of the points we're talking about, investors are taking on more risk. And at a high level, it's either do you want to take on illiquidity, which is the private route, or do you want to take on leverage, which I don't think we've talked about yet, but that would be more of like a portable alpha route. And then within the absolute return framework, you have the whole issue of, is a strategy uncorrelated or is it something that's more of a hedge? And then this gets to really muddy all this up. This gets to a return issue for, I would presume that for Suzanne, if her absolute return target is higher, she probably would tilt more toward uncorrelated strategies because in general protection, or to use the jargon, positive convexity in a negative or in an equity market drawdown is expensive. Insurance costs something. You tend to see a lower expected return then when you go into those types of assets. So
we've got a question from the audience about long vol hedge funds. So do you have any experiences to share with LPs tolerance for investing in long vol hedge funds, or even what are the challenges over a full market cycle of hunting for those managers, and both the absolute and the underlying costs with them?
Yeah, I like that. Hey, Paul, let's answer the question, but then let's hold off on the rest of the Q&A questions till the end. Go ahead, please.
So we build specific portfolios for specific client needs. And so as a general point, most of our clients, and especially when you think in the strategic asset allocation framework, a tail risk strategy will have a negative expected return or a zero expected return. It will be low. And for clients with high returns or high return targets, it doesn't fit well. So what we're much more likely to do is look at managers like Global Macro that can adjust, and we'll spend hours and hours with them on the front end on the due diligence cycle, where we know that they can adjust their portfolios in different market conditions. And so as an example, we had managers, Global Macro managers, who heading into 2020 were basically long risk. They thought the economy in late 2019, they thought the global economy was on the front foot or would soon be on the front foot. So they were long risk, which would be corresponding to be short volatility. Is unfortunately the COVID-19 is that spread around the world. They adjusted their portfolios, and some even adjusted in March, where they went from being short risk and down for the month to being long risk and finishing the month up. So to directly answer the question, we don't have a lot of managers that have a permanent long vol orientation, but we are much more friendly with managers who can have the skill to swing back and forth.
Got it. That makes sense. So for example, it might be pretty expensive to purchase options, but at the same, if you're able to get positive convexity through Global Macro and trend following managers that can improve your portfolio. So I guess we kind of transition from why to how, and we're talking a lot about how our risk is going to change going forward. We're talking about risk mitigation strategy, and we're very fortunate to have one of the best experts in the world on this topic, John Linder, who actually came up with the idea of crisis risk offset and risk mitigation strategies. And this brilliant idea has been embraced by some of the most successful public pension plans in the US, whether it's CalSTRS or Hawaii or some other one. So John, could you please tell us about this really interesting idea how to use risk mitigation strategies in global portfolios? And also, I'm going to throw a curveball as well. Is the idea dead? I know that the idea heavily relies on fixed income exposure, but when the yields are so low, is it an outdated idea that we should forget about?
Wow. All right. There's a lot packed in there. Well, thank you, Murat. And I wanted to indicate that, you know, the why, come back to the why and then go on to the how. I do think that there's a lot of powerful forces arrayed to try to get economic expansion, and I think we're going to see a significant economic expansion. Whether that will mean that we have, you know, higher inflation, most likely higher rates, but I don't think that, you know, they're going to get necessarily out of control. But nobody can really see the future, much less me. So what you try to do is recognize in the whole concept behind a risk offset mindset is that we know that all institutional portfolios have an overwhelming orientation towards economic growth continuing. So if basically we never see another recession, everyone's going to be fine. You know, everyone is going to meet their objectives and everyone's going to be happy. However, history would indicate that we probably will see another recession or another economic drawdown caused by, I don't know, a global pandemic, or maybe Archegos, you know, blowing up, or, you know, long-term capital, or, you know, these things come out of the blue. And then there's the garden variety economy overheating, the Fed needing to step in, raise rates, and basically doing an engineered crash of the economy. So the question is, what do you have in your portfolio that is going to offset those times? And the reality is that we have been recently moving further and further away from our traditional offsets because there is a fear of rising yields. And frankly, the best long vol strategy out there has been long treasuries. It gave you a positive carry, it gave you a positive expected return, and it gave you incredible convexity when there was an economic calamity. Great. I think there is effectively a concern, obviously, that, you know, with the long bond at 2.2, that's problematic from a return expectation point of view, although the carry on that over cash is huge. Still, it is, you know, it may not fit your return to risk profile in normal times, in the assumptive that we're going to get economic growth next year. And so what do you do about that? And what you know, shoot, now this is, I'm going to break it into two things, because you asked about crisis offset, you asked about offset, and you know, what we did with my former firm and my colleagues is to build a risk offset strategic class that incorporated, at that point, treasury duration, which was a major factor, systematic trend following, and then to a lesser extent, market neutral and global macro strategies. And for today's, what I would say in retrospect is the market neutral strategies do not belong in a risk offset class. They have a sneaky way of unwinding when there is a calamity, and therefore they don't offset. In fact, they add to your pain in drawdown. So appropriate strategy, they just don't belong in the crisis offset class. Treasuries, obviously today, kind of an issue. So, you know, that used to be up to 50% of a risk offset class. So what do you do? And, you know, as a firm, SLC Management has developed strategies that are systematic duration extension strategies that hold a shorter duration of high quality bonds and higher carry type permanent portfolio with a lower duration for that, first responder, but then put on a lot of duration systematically when there is a significant rise in market risk like last spring. So we were able to add an additional 15 points of return in the spring by adding duration to those bond strategies at, systematically extending. So that's a solution that we have, that we've come up with that is kind of a fix for a standing long treasury, because holding, a 50% position in that class at, duration 20 is going to be painful, in my opinion, over the next couple of years. Of course, we could get an event that makes that protection, that standing protection, extremely valuable. But I think that the right down the fairway is likely to see somewhat higher rates and therefore some pain from that part of a crisis offset portfolio that can be remedied with a little bit different structure. We still think that systematic trend following and global macro have a place in that portfolio, as well. So that's kind of where our thinking is at on risk offset. Like it.
Wow, there's so much information there. So let me try to recap it a little bit. So when you came up with the idea of crisis risk offset, it really included three key buckets. So the first responder was fixed income, roughly 50%. Then you had
treasuries. Let's be specific.
Yeah. I'm sorry, treasuries. Yeah, long duration U.S. treasuries. Thank you. Then the second bucket was CTAs, trend followers, and global macro managers, roughly 30%, I believe, right?
Yeah. Which
were second responders. They tend to perform well during crisis. And the last 20% were market neutral strategy with the idea of trying to improve long-term expect returns without hurting performance during crisis.
Right. They were kind of a cheat, and we recognize that cheat doesn't work so well.
So I got it. So
what are your views? What are your views if you've replaced it? Have you found something different?
Yes.
Effectively
exactly. So
reallocating.
So John, I'm curious. Let me just rephrase that question. So if you were to think about the crisis risk offset product you recommend today, given today's market environment, what would it look like?
I mean, I would say it would have shorter standing duration, given where rates are at. It would have systematic duration extension, utilizing an overlay of U.S. Treasuries into risk environments. It would have systematic trend following and global macro, depending on what the client's opinion is about those two. How much systematic trend following do they want, vis-a-vis higher cost, but more different return profile CTAs. And so it would be a mix of those elements. The easiest one or the simplest one would be just 50-50 in duration strategies and global or trend following. But of course, you can in the 50% CTAs, you can kind of mix that according to client desire. But I think those are all valid, and they're all potentially offsetting strategies. Whereas, we've just seen that market neutral strategies don't offset, and they tend to hurt in unwind events.
Yep, that makes sense. So
can I ask about CTAs? In the sense of, and maybe Murat, you have thoughts. There's so much equity beta that many of them have embedded. So, the real question is, which is the greater risk in a crisis event? The market neutral strategies that have leverage and exposed to the unwind or rotation, as opposed to the beta the equity beta that's nestled into your CTA trend follower. How do you think about those risks? In some ways, Paul, have you seen clients become less afraid of CTAs and get to them, or are you seeing them understand the equity beta?
Well, and I want to ask another question. I'm going to layer on Suzanne's. What was the experience of CTAs on the turn in the spring, Murat?
Yeah, sounds good. So you guys are like, you're putting me on the spot, which is fine. I love talking about CTAs, and so Paul and I actually have a number of conversations about, CTAs and different hedge fund strategies, which is always fun. So I think at a high level, people always ask this question: hey, what drives performance of CTAs? How are they going to perform during different environments? And I think that that John's framework is probably the best way to look at CTAs. So when he looks at crisis risk offset, describes U.S. government treasuries as the first responder, and CTAs are the second responder. And the reason for that is because CTAs, they're not necessarily expected to protect you immediately at the reversal in the market. As you said, when the stock market goes up, they might be long, right? And it takes time to reverse those positions. So if you look at Q1 of 2020, I think that's a really great question, because it actually highlights the fact that CTAs perform quite differently from each other. And just to kind of step back a little bit, if you look at CTAs, and even if you look at the largest 10 trend followers that are components of the SocGen trend index, a typical return dispersion among those highly correlated, 70–80% correlated manager is about 40 to 50% from year to year, right? So on any given year, you'd expect to see a huge dispersion returns, and that's really driven by lots of factors, such as sector allocation, different signals that they use, different allocation across time frames, and even small implementation choices can have very significant implications. And we've seen a lot of that in Q1 of last year, because, and I'll share a couple of data points. For example, we saw that managers who had higher exposure to commodities tended to outperform the rest of the trend following universe, because commodities continue trending, whereas stocks and bonds reversed. Then if you look at managers who are a little bit shorter in duration, those have performed quite a bit better than longer term managers who got hurt by the reversal. And another factor, just the role of luck was very important. Our CIO built a very simple model to illustrate that. And when he changed the look back period for trend strategy by something like 4 or 5 days, during this period of February, March of last year, the implications would have been close to 800 basis points, if I remember correctly. So even small difference in implementation would have caused very significant differences, because the moves in the markets were so violent.
So Murat, can I ask you, one of the things I love thinking about as an investor is the decision making. And so this is data that this is broad data, specific period of time, insights, depth of insight for this opportunity set. But when you think about the decision making to select for that skill, without actually knowing what the future is going to hold, is that what drives your beliefs and process? Or Paul, do you have other thoughts? And that is looking at shorter duration, looking at shorter time horizon, or sort of preferring commodities, or are you looking to something else for the next opportunity?
Oh, that's a great question. I guess what I should have mentioned is that so although commodities performed really well last year, that was not the case for the previous few years.
Exactly.
And it's true for short-term managers. The short-term managers really struggled since 2008, 2009. At the same time, last year was great for them. So what it really comes down to is that I would not argue that you pick one particular strategy. I believe in well-diversified portfolios. And I think we're fortunate to keep commodities and short-term exposure. It helped our portfolio during Q1 of last year. But there was a cost of keeping those portfolios in the previous couple of years. So it's really, investment decisions are difficult.
Yeah.
So I'm curious, Paul, what do you think? I mean, you look a lot at different hedge fund strategies. You understand CTAs really well. Like, how do you see CTAs as being part of global portfolios?
I'll start really high level before diving into it. And I think there's a ton here, and I probably won't hit everything, but I think one of the really important points, I think we've all alluded to it just now, but just to make it super clear, is that while we believe hedge funds are not an asset class, because that's largely due to the dispersion that you see in realized returns. And then when we go talk to managers, we see everything that we've already talked about, and that small changes in processes can make big changes in outcomes. And so we really spend a lot of time trying to find the best managers that we can, the top managers, because the return differential is so big. So I think it's very, I think a benefit of that is that you can think as a firm or as an organization about basically your enterprise risk tolerance. And so one way to think of it is, what can you live with versus what's really painful? And for some firms, it could be like a quick reversal, maybe, or not a quick reversal, more like a bad quarter, like the fourth quarter of 2018, where markets, like, are you trying to build your portfolio to be resilient in a quarter, or are you trying to build your portfolios to be resilient against like a 2008? Because you would probably have different managers. And the key with manager research is that you know the underlying processes. And if you understand the managers on a bottom-up basis, it helps you put the portfolio together in a way that ultimately fits your needs.
Exactly. I love that. I think that's, I think what really comes down to is that ultimately, I think you need to understand what you're trying to protect your portfolio from and build a solution that actually addresses this need. Okay, John, you had some thoughts as well.
Well, I want to piggyback off what Paul's saying, and what's really important is to recognize that your client, regardless of what they tell you, has a pain threshold. And so when we when I was putting together a risk offset class, strategic class, we understood implicitly that clients cannot tolerate negative carry strategies. So basically, strategies that have that are insurance, but not only insurance. So insurance has a negative expected return and a negative carry. Okay, right? You don't expect to make money from insuring your house, but even strategies that have a negative carry but a positive expected return, so tail hedge strategies that are maybe buying mispriced options, clients can't handle those either, okay, for any long period of time, because they get hedging fatigue. And so we recognize that, and that was one of the reasons, Suzanne, that we put the market neutral strategies in the crisis risk offset class, to try to offset some of the your trend following strategies tend to be positive skew, so they have small losses in some years and small gains, and then they have a big gain in 1 year every 7 years or so, right? That's a hard profile. And then you had treasuries that were positive carry, etc. We were balancing all that. And so, as Paul indicated, it's really important to recognize that what your clients can handle, even if they, that that it may not be the ideal build, you try to make certain that they're there when the event happens, rather than not being there with the risk offset portfolio, even if it's not the perfect risk offset build.
That's right. Just one quick point, I should have mentioned this. So, because I think Paul talked a lot about return dispersion, and as a firm, efficient we believe that multi-manager solution is the right one when it comes to whether CTAs, hedge funds, or ERP solutions, because of the return dispersion problem. The return dispersion is high, persistence of returns is low, so that's why we believe that ultimately multi-manager solutions are much more attractive for clients. However, we see a lot of very sophisticated institutional investors not doing that. We see a lot of them going with 1 or 2 managers, and it's disappointing, because I think taking that idiosyncratic risk is painful. What happens sometimes, people have a bad experience because of choosing one or two managers who just underperformed. and making a conclusion about the whole asset class. So it's something to be careful of. Okay, so I think we've covered a lot already, and I'm just trying to manage time here. So please forgive me that I know we have so much more to share with everybody, and I would encourage the audience to reach out to the panelists afterwards with your questions. They have a lot of expertise in this topic, so please free to follow up with them afterwards. But let's try to address a couple of questions from the audience. And Ken, if you could also pull up the poll results, would also be quite interesting. Okay, so I'm wondering whether, so guys, I would like you to take a look at the poll results, but also let's take a look at one of the questions from the audience. So one of the questions there is about CRO. So what has been the biggest challenge when implementing a CRO portfolio? And I'll ask John to please answer the question for us.
Okay, I'm moving the poll results from in front of my face here. The biggest challenge is effectively staying with it, and so just preparing yourself for the fact that you hope that you don't need to use it, and so you should benchmark it appropriately and basically understand that there's only so much you can do during the good times, and if you just keep it above water, great, you're winning. But having the knowledge there that we will have another event and we will have another recession. Those two things are very different, and I kind of wanted to mention they are very different in that trend followers tend to do better in a garden variety recession because they're longer and there's more time. Events, fixed income tends to do better because ultimately when you enter the event, and if it's a terrorist attack or something, the next morning you're going to figure out how much your equity market is down, right? And there's no there's no time to reposition. So those are some elements, and then just making certain that it's reasonable cost and well explained to your decision makers.
Yeah, well, thank you, John. I know that we're fortunate to have you as the CRO expert here. So Suzanne, I have a question for you as well, but I'm looking at the poll results, and the question number 5, what is the environment that you find most concerning? And the majority of people choose coinciding periods of rising rates and falling equities. So would you say that's accurate for you and your portfolio? And if that's the case, how do you think about protecting your portfolio from that environment?
I think that's interesting. And so the question then is, if you look at the other questions, what might be underlying, the path or of that? And if you look at the first question on inflation, moderate inflation, maybe the 3 to 4% might be considered moderate, and the 5 to 6% might be, one step away from runaway. And so the nuance that I might add is, if we are in a sustained inflationary period of time that migrates to 3, that migrates to 5, the question for people is, for some inflation, equities are going to be just fine. Some of us are going to have to move away or move towards the value investment stocks, the beaten down sectors of industrial cyclicals, banks, those sorts of things. And so our portfolios may have to catch up to that. I think one ways of thinking about that is what kind of, and somewhere else they also say real assets is their best expecting. So those are kind of married together, but in some ways, can you put equities, right? So people are thinking about infrastructure, but can you put actually sort of commodity sensitive, inflation sensitive equities in a real assets portfolio that sit next to some other traditional, maybe illiquid or traditional real assets? The real question that none of us has any experience in, more than likely on this audience, is how do we handle that environment? And so Do I think that we've cracked the code? I don't. You know, maybe bad news for John. What it seems like what we're doing in skewing our portfolio is less from the deflationary risk and more from thinking about total returns and possibly total returns coming from other asset classes in the real assets opportunity set. You know, I think it's tricky because I don't even know if real estate's a good inflationary opportunity, inflationary asset, but that's where people put it. I could go on, but I think I'm interested in thinking about even some of the diversifications. Like, so John, when you think about your risk offset, and Paul, when you thought about framing the question, which is treasuries, liquidity, total return, uncorrelated to equities, our largest risk, you know, the magic characteristics of one asset class, and that may not present that in the future. There's other things that we really need to frame those things. So one thing I might want to throw out as a question mark is, what about short duration EM currency? Has anyone thought about that? Now, there's some shockness to it. So the question is, what's your time horizon? Or even China A convertible bonds. You know, what's the opportunity to find both the different market as well as some positive gamma that if you have time, like John said, you're not going to have sort of a one-day shock, a 9/11 event, and have both liquidity and protection. But if you can think long-term, are some of those things? I mean, Paul, you probably face that a lot with clients, and that is they want the magic without actually having to face that there's trade-offs. What are you doing? How are you guiding?
Well, I just let me jump in real quick. One, Suzanne, thank you so much. It sounds like how you're not as concerned about the four scenarios as described in poll number 5. You're more concerned about inflationary environment coming down the road, and that's what we're really trying to prepare portfolios for. And just I want to kind of jump in with a couple other things. One, if you look at the answer of coinciding periods of rising rates and falling equities, I think that's really good news for you, John. So I'm cheering for you because I think that you're going to see some asset flows going your way. And also, like a quick question about that I have for Paul is about if you look at question number 3, poll question number 3, and which instruments people expect to perform well, hedge fund strategies are pretty close to the top of the list, right? So is that surprising to you, Paul? Or, you know, if you were advised to somebody to capitalize on that, like what would be a couple of things you would share with the audience?
So there's a lot. I'll try to hit that. I'll try to hit your question directly. I think that well, it's interesting from a very high level. We had an internal discussion maybe a month or two ago where we thought from like a long-term mean reversion perspective, what is sort of hated, what should we rotate into, especially if you believe the idea that we're maybe coming, and I think this has been a background point, that we're entering like a new regime. And probably the assets that are most hated because they just haven't worked all that well in aggregate the last 10 to 15 years are commodities and hedge funds. And I think, you know, we've talked about commodities a little bit and CTAs, and we can kind of go back there. But I think that the one way to frame the question of hedge funds is we very much believe that they're active management techniques, or they capitalize, or you should focus on those hedge funds that are really good at active management, as opposed to just capturing beta in a vehicle. And so I think one of the kind of implicit in the regime change question is if we're going from a period where you basically just wanted to be long and strong equities because of Fed support and the economy's coming out of the GFC, are we entering a period where there's more dispersion, where basically alpha or active management really matters again? And I think part of the reason you would rotate toward hedge funds at a high level is whether you think that betas are priced to perfection, or that we're having more dispersion, or that there's more implicit, we're moving from a period where volatility was suppressed so that the economy could get back on its feet, to a period where volatility is going to be higher, and maybe that's COVID related. But I think that's part of why you see more interest in hedge funds. And I think from there you can split the interest out in different ways. And I think you know, the Greeks were mentioned a minute ago, which made me smile. I was trying not to get that granular, but that goes back to the question of what are you really trying to do? Like with gamma, like a spike in gamma, you're really trying to, you're looking at a sudden change in the rate of change. And so that would be like a quick reversal. And that wouldn't necessarily fit like with a CTA strategy. But going to that's more of a trend following, depending on where you go, that's more of a sustained, I use jargon myself, that's taking advantage of autocorrelation in prices, or just things keeping moving where they hadn't done that before, they've been choppy. And to the point about rising rates and falling equities, you know, I'll have to give you credit, Murat. You guys at Efficient actually wrote the study. I was fortunate just to collaborate, but history shows that in periods like that, that's very difficult for beta strategies. In terms of like stocks and bonds, you have losses in both. And because that's a big part of portfolios, you either want to be someplace else, which I think when you're looking at long time series, it's probably commodities, or you want to be doing active management techniques. And an easy one there, to going to John's point, is trend following. Essentially, if you have a period of higher autocorrelation for maybe 12 to 24 months, then trend following basically makes you bearish, where you're short equities, or you benefit from being short equities, and you benefit from basically being short rates. And to the icing on the cake would be if commodities are moving and you're long commodities, where you're winning all the different ways. And so, you know, just I myself, it does feel like we're entering into a more volatile environment. And I think that's part of why the combination of basically assets being priced to, I won't say that they're overvalued. I wouldn't just beat the drum on that, but I think it's fair to say that they're priced to perfection, or they're priced to a very optimistic scenario with continued earnings growth and kind of a benign environment on the part of the Fed, where rates change slowly. And so I do think that there's more interest in hedge funds, especially as tools of active management to help asset owners like Suzanne meet their overall return goals.
Well, thank you so much, Paul. This is a very exciting conversation, and I know that we can go for a couple more hours because Suzanne, Paul, and John have so much to share with you guys, but unfortunately we're out of time. And we covered a lot today. We talked about why the topic of low yield environment is important and challenging. We shared a lot of different solutions, whether it changes to strategic asset allocation, whether it's making some tactical shifts on the fixed income side, whether it's maybe tap into emerging markets, currencies, whether it's making changes to your hedge fund portfolios. So we covered a lot today, and thank you for answering the poll questions. Thank you for submitting your Q&A questions as well. And thanks so much to the panelists. You guys are experts in this area. Thank you for taking the time out of your busy schedules to share your insights with us. And finally, I'd like to thank Meg. Thank you so much for organizing this really incredible series of events. I think it's very valuable and beneficial to every participant. So thank you for putting together a very thoughtful series of events.
Thank you, Murat. At the beginning, you said, you know, why should you be spending some time with us on a Friday morning? Well, I think that's a great example. That was just an amazing discussion. And you're right. I think we could go much longer, but thank you all for sharing, you know, so many really thoughtful remarks and solutions. I mean, we had a huge audience today, very, very terrific. And thank you so much for spending your time with us. Just a quick note that we do not have a webinar next Friday. We are taking our coffee break, and we will be back with you May 7th, May 14th, and May 21st. And that will sort of finish up our spring series. So thank you so much to everyone, and enjoy your weekend.